Becoming poorer and poorer. Hello everyone and welcome to our economy YouTube channel. Today, we will be discussing the impact of inflation on your financial situation and how to protect yourself from its effects. Inflation is a persistent increase in the general price level of goods and services in an economy over time, and it can have a significant impact on our purchasing power and standard of living. How inflation makes everyone poorer. Inflation can make everyone except for the wealthiest individuals poorer over time. This is because as the prices of goods and services increase, our purchasing power decreases. For example, if you used to be able to buy a loaf of bread for $2, but due to inflation, it now costs $4, you have lost purchasing power. This means you can buy fewer goods and services with the same amount of money. As prices continue to rise, your savings and investments lose value in real terms, making it harder to achieve financial goals and maintain your standard of living. Tips to avoid becoming poorer with inflation. Invest in assets that appreciate in value. Investing in assets that have the potential to appreciate in value, such as stocks, real estate, or precious metals, can help offset the effects of inflation. Over time, these investments may increase in value, providing a higher return than the inflation rate. However, keep in mind that these investments come with risks, and it's important to do your research and diversify your portfolio to minimize those risks. Take advantage of tax-advantaged retirement accounts. Tax-advantaged retirement accounts, such as IRAs and 401(k)s, can help grow your savings over time. These accounts offer tax benefits, such as tax-free growth or tax deductions on contributions. By taking advantage of these accounts, you can maximize your savings and potentially offset the effects of inflation. Consider investing in bonds. Bonds are debt securities that provide a fixed rate of return over a set period. Because the rate of return is fixed, they can help protect your savings from inflation. However, keep in mind that the interest rate on bonds may not keep up with the inflation rate, so you may need to adjust your investment strategy accordingly. Keep an eye on inflation rates. Finally, it's important to keep an eye on inflation rates and adjust your investment strategy accordingly. If inflation is high, you may want to consider investing more in assets that appreciate in value, such as stocks or real estate. On the other hand, if inflation is low, you may want to focus more on fixed income investments, such as bonds. Build an emergency fund. An emergency fund is a crucial part of any financial plan, and it becomes even more important during times of inflation. Aim to build an emergency fund with at least 6 months' worth of living expenses. This fund can help you weather financial crises, such as a job loss or a medical emergency, without having to dip into your investments or take on high-interest debt. Diversify your investments. Diversification is a key principle of investing, and it becomes even more important during times of inflation. By diversifying your investments across different asset classes, such as stocks, bonds, and real estate, you can minimize your risk and potentially increase your returns. However, keep in mind that diversification does not guarantee a profit or protect against losses. Avoid holding too much cash. Cash loses value over time due to inflation, so holding too much cash can be detrimental to your finances. Instead, consider investing in a high-yield savings account or a money market fund. These accounts can provide a higher return than a traditional savings account, while still providing easy access to your money.